Today, I'm joined by Sandy Kaul, who's the Senior Vice President of Franklin Templeton and one of the contributing authors to this piece. So I'm excited to bring some of these concepts that we wrote about to life. And Sandy, welcome to the conversation.
Thank you so much, Aaron. My pleasure to be here.
Great. Well, so Sandy, you've been in this kind of space where you've written a lot about the industry, whether it's changes in particular asset classes or just the industry as a whole. And I'd love for you to just kind of talk about your observations maybe over the past 10, 15 years as in finance generally and kind of the investment industry. And then maybe we can hone in a little bit more on some of the things that you've seen, particularly in the private markets and the alternative space.
Yeah, great. I think that we've been in a very, I think, transformative period for the financial industry. We've really seen a huge acceleration of some trends that were just beginning prior to the global financial crisis in 2008. And we started to see these trends really begin to gain speed in that post period beginning 2009, 2010. And you can really think of these as a barbell, right? On one side, you really saw the rapid and very extensive adoption of passive funds, first in the US, particularly the ETF structure, because of the tax advantages that ETFs gave over mutual funds. And that has accelerated to the point that for the first time in 2023, we actually had more AUM in passive funds in the United States than in active funds, which is an amazing milestone. If you think about that, the fact the industry was almost 100% active 30 years earlier. Meanwhile, you've also had this accelerating trend on the opposite side of the barbell, where you have seen more and more money moving out of any publicly traded markets, even out of a lot of the hedge fund strategies that operated in publicly traded markets and into private assets. Private equity has been the primary recipient of this money, but we've seen the emergence of the private debt markets after the Basel III rules came into place and banks started backing out of some types of lending. You've also seen the emergence of new types of infrastructure products as we've started to really go through this green transition that the world is looking at. And you've seen highs and lows in the real estate markets. So you've seen a lot of money come into alternatives on one side of the barbell and into passive on the other side of the barbell, which has left our traditional active managers really struggling to find the right strategies that are going to really differentiate them. The more we're able to isolate return streams, and this has really been aided by better risk tools, better analysis tools, we've been able to isolate more of the factors that have really been driving returns, turn them into indexes, and let them be passive. So you're really seeing the splitting of the asset management industry.
And Sandy, one of the things that we talk about in this piece is the whole kind of journey to alternatives, particularly on the retail side. And your piece is kind of, if I can make the analogy and extend it a little bit further, you're the world building part of the narrative of the hero or heroine's journey that we see typically in movies and books and all that kind of stuff. So there's a lot of really good data that you're sharing, a lot of good trends specifically that you're sharing as you're building that world. So as you think about that narrative of the journey, if you will, and that world that you've built in this piece, where do you think we are in terms of kind of alternative adoption, whether it's on the product side, attitudes from the advisor community? There's a lot that you can go there in terms of you think we are, but in that world building scenario, where do you think we currently sit?
I love the analogy, Aaron. I've always wanted to build worlds. So here we go. Um, so I think that, first let's just talk about the implications of the barbell, right? As more money moved out of the public markets and into the private markets, you've started to see, particularly in the developed markets, significantly in the US, you've seen fewer and fewer companies going public, right? There has been plenty of money available for private funds, from private funds to be able to fund companies. And you're starting to see this very odd shift in the capital raising pattern where instead of going to market while they're still small cap or mid cap, many companies are now waiting until they're large cap or even unicorns to go to market. And they're not going to market to raise capital like they did in another period. They're going to market typically to help their employees monetize all of these outstanding options and stock and equity that they have in the company. So that has really disadvantaged many individual investors. It's been great for institutions and for the high net worth investors that had the qualifications and the time horizon to be able to be in these private funds. But it's really been very difficult for individual investors because a lot of the growth opportunities that they were able to access in the past have shifted out of the public and into the private markets. And that has really set the stage for this interest in retail alternatives, in trying to think about new wrappers that offer more liquidity and allow retail investors to be able to share in some of these exposure to the private funds. There has been mixed uptake of this, right? I think that the structures themselves, while more liquid, are still not as liquid as public markets, of course. They're also a little confusing, right? There's a lot of kind of new terminology that a lot of advisors have to learn to be able to put people into the funds. There's a lot of facilitators that they have to work with that they've never worked with before, that are creating the feeder funds or creating the share classes that allow these access to these vehicles. And that creates some anxiety for advisors because advisors like to be portable and move their book if they change firms, and you can't really move from these platforms. And I think that there's also been some concern, right, that, is this appropriate investment for many individuals who really do need liquidity sometimes upon demand, right? Things happen, you lose your job, a parent gets ill, a child gets ill, or someone has to go to college, right? There's times that you need liquidity as an individual that you can't always plan for, like an institution can. And so there has been uptake. I think that you're starting to see more interest, but it's a big educational hurdle. It's a systems hurdle, an operational hurdle, and it's also just a mindset shift hurdle that people are having to get used to, and advisors don't want to put clients into something that they don't understand and can't explain. So we are seeing uptake. I think that it will continue to grow, but it's going to take, as you say, a journey.
Yeah, and I like the analogy of the barbell that you've talked about. And if I kind of extend that a little bit further, there's the whole, past 10, 15 years, we've kind of gotten used to the operational element of that getting much easier and easier. Now we're almost going back and kind of trying again. And maybe 10, 15 years from now, it gets a little bit easier. I don't know. You have your crystal ball.
Hopefully not that long, Aaron. Hopefully not that long.
Well, great. I want to spend a little bit of time on the access comments that you made. So in your piece, you talk about the different fund vehicles that have come to market, whether it's interval funds or feeder funds, BDCs, non-traded REITs that kind of sit in that in between phase of fully liquid, fully illiquid. But then there's kind of that last bullet point that you talk about, and I know you've done a lot of work on digital assets, tokenization, technology around that. And that's almost, maybe it's a different animal, maybe it's not, but could you just talk about what you've seen in terms of I guess the quote unquote traditional vehicle access of the aforementioned vehicles versus the tokenization access? And we've seen a couple of launches in this space, but we'd love your thoughts there too.
Yeah, I'd say we're in the experimentation phase to really kind of understand what is the structures that are going to work well, right? And Europe will be joining this experimentation phase, I think, more fully this year with the new LTIF rules that they have coming into place in 2024 as well, which will help strengthen their ability to experiment with products. But so far, all the traditional products from either the regulated 33 Act and 40 Act side in the US or from the UCITS side in Europe and internationally, they have to fit certain rules around how redemptions can work, how frequently you're able to rotate capital in or out of the fund. And these are new things, right, for most advisors in the retail space and individuals in the retail space who haven't really ever had to deal with that kind of thinking about the liquidity of the investments in their portfolio. Tokenization is a new platform, right? Tokenization is a way of wrapping a fund, right, in a new vehicle that makes it very transportable on these new blockchains that we're seeing in the sandboxes of many regulatory jurisdictions right now. And more of the central security depositories and more of the exchanges are starting to offer blockchain based trading. And on a blockchain, you are able to move an asset and move the payment mechanism for that asset almost simultaneously, right? And that creates a very fluid operating platform. And so this has been very tempting to try and put some of these private fund shares or exposures into these tokenized wrappers because it does create that liquidity upon demand, which is really what many of the retail advisors are looking for in the portfolio. And there has been some launches, and we've seen some exchanges emerge out in the Far East, more smaller exchanges, more private exchanges in different jurisdictions in the US and Europe, where people are looking to trade private fund shares. And that could get very interesting when they're in the tokenized wrapper because they can also get fractionalized down into very small increments that would work well for individual portfolios. The question, that kind of sits out there with all of this is, can you put an illiquid exposure into a liquid wrapper and create an access vehicle that doesn't undermine the longer term value proposition? I think most people at this point have come to the conclusion that you can't do that if you're going to make it just a share class of an existing fund, because you don't want the more liquid tokens starting to influence the longer term valuation that does not get marked to market as a token would every day. But that perhaps it's a better vehicle for new funds and new investments that can be put into those wrappers that can be targeted much more for a retail audience. So I think that this is a very big area of opportunity, and we're likely to see a lot of experimentation in this space alone. And because you're thinking about new assets to put in new wrappers, we may see very different kinds of alternatives being targeted for a more retail audience, right? And a great example is like fine art, right? Museum quality art isn't something that most individual investors can buy. But if you can put that into a tokenized wrapper and put that out on a blockchain and fractionalize it, you could really start to open up those types of opportunities. So it may not be the same private equity and private debt that ends up being successful in the tokenized wrappers because of the liquidity mismatches with the underlying investments, but you might start to see very new categories of alternatives emerge.
That's really interesting, and I think we've seen some attempts of that. Artwork is kind of the obvious one, and but even other collectibles as well. I mean, you can probably trade Pokemon cards on a tokenized blockchain at this point. Maybe going back to the private equity side, private credit side. So if we're taking this and putting a wrapper around a fund, maybe an oversimplification, but is this just a more efficient LP-led secondaries type of market where instead of going, bilateral between two LPs, you've got more of an exchange? Is that a good way to think about it, or is it slightly different?
I think that's the hope, right? That's the hope that we get to. I don't know if we're finding that much liquidity to be able to really kind of say we've hit that point yet. And I think that, we've also got to be a little careful because, if this is an LP share and it's an LP that's also held in a longer dated lockup fund, you don't want the different valuations of that same investment coming back to haunt a manager, right? So I do think this is very much an allocation exercise as much as it is a structuring and a wrapping exercise. And I think they've got to balance all three. What's the right asset to put in it as an allocation? What's the right structure that you can use to create an adequate level of liquidity for a retail audience? And then what's the right venues to think about offering that structure so that there will be sufficient liquidity that you can really use the new retail audience and give them those exit points that they need to feel comfortable with these investments in their portfolio.
Hmm. So maybe a final question for you, Sandy, is kind of the business model of, particularly on the asset management side of of the industry with this alt tidal wave that seems to be coming and continuing to come. So there's a couple ways you can do this as an asset manager or a GP. You can buy or build, and Franklin Templeton has been a big buyer of boutique managers. There's others that are building out their own capabilities internally. There's probably some in between. So, maybe if you want to talk about FT and the way that you all have kind of approached this, but also what have you noticed in terms of the direction of the wind in terms of buying versus building?
Yeah, I mean, to build a more retail focused segment of an alternative practice, you need one of two things, right? You either need a sufficiently large platform where you can really bring on and hire lots of additional people to build out retail relationships, to really start to forge that strategic partnership with the home office or with the lead partner group in a network, and the technology to really be able to connect into these platforms because they're very different in terms of how they handle their public market exposure. So there are a number of larger alternative firms that do have the resources to be able to do that. And they have the resources to really make this a long term part of their business growth. And we've seen them really working in that direction. And this is where you see the Blackstones and the Apollos and the KKRs and the Hamilton Lanes and the Carlyle groups. I mean, these firms have the platform to be able to do this. And you're likely to see this from others, right, that have large platforms in the alternative space. On the flip side, you need to be able to then, if you don't have that scale and that ability to hire and build out those networks, right, you can affiliate and join a firm that has a large retail or a large wealth focused business but doesn't have alternatives. And Franklin Templeton is a 76-year-old brand. We've got 1.6 trillion in assets under management, and the team really decided that this was a great platform to be able to extend. We have deep relationships with wealth firms all over the world and advisor networks, and being able to use that depth of relationship to begin to introduce these alternative products, we're really coming from a position of trust with the advisors. We already have an academy that we've been working with advisors for years on, where we're doing training for advisors. So adding training around alternatives or training around digital assets is a very natural extension for us. So we're able to come in and do that educational component. And as a result, what we've seen is we've been able to attract some excellent quality alternatives managers who want to build out that retail access, but don't want to go out and start building and hiring from their own firm's perspective. They want to tap into our existing network. So that's been a great partnership. We've been very successful in the retail funds that we've raised, but we're also very careful. And each time we raise one, we really do start with a huge educational campaign. We start with a large amount of really going through and helping the operational teams of the different networks, right? It's a very different approach to sales than you would normally see with the public market fund. So you have to kind of have the commitment on both sides, the commitment from the traditional platform that has the wealth relationships and the commitment from the alternative firms who don't have those relationships but have the subject matter expertise. And so you've seen both models. I think both models can succeed. I think it's going to be the toughest is going to be the smaller firms that have been very successful in a high growth period that aren't sure they really want to either affiliate or sell themselves to a bigger platform, but don't really quite have the scale or the resources to begin to grow. They might get caught out a little bit in the middle here and face some tougher decisions if the capital raising environment remains challenged, right? And with higher interest rates, we've certainly seen that. So there's a big strategic decision point coming from many firms. I think, but both options are very viable. You just kind of figure out your own kind of willingness to make the investment or make the affiliation.
Great. Well, Sandy, thanks so much for the discussion and for your contributions to this paper. I think people when they read this will get a really good sense of where we've been and then where we're going from just even your piece and then all the extension beyond that. So really appreciate the time.
Well, excellent. Thank you. You guys do great work. Love to be part of it.